Applovin stock has taken investors on a roller coaster ride after shares started off the year rising to over $500 per share. They fell closer to $200 a share. Since they've recovered to over $310, and investors are feeling a little bit better about this investment. Of course, one of the reasons why Applovin stock price fell so much is because of short seller allegations from companies like Fuzzy Panda Research and Culper Research that have alleged that Applovin is violating App Store terms and engaged in unethical practices, including dishonest advertising and unauthorized data tracking. Now, I'm always skeptical when short sellers make allegations about a company. They're obviously incentivized to bring the share prices of a stock down, and the stock prices can react before a company has a chance to respond to the allegations and before the company has a chance to report on the things that the company is being alleged for doing. Sometimes short sellers are successful, other times they're not, but they're always self-interested and they're held to less rigorous standards than publicly traded companies, which are regulated by the Securities and Exchange Commission in the financial results that they report. So I do take these short seller allegations into account, but with a skeptical eye into their intentions. So I'm going to reevaluate Applovin stock here. Of course, I've had it rated as a buy for more than a year now. It's one of my best performing recommendations. The stock has soared even after this decline. It's still significantly higher than when I first recommended it as a buy.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
One of the reasons why Applovin stock has soared is because of the company's revenue growth at profitable scale. So revenue growth has accelerated in recent quarters after turning negative in the first quarter or the fourth quarter of 2022. It's rebounded and it's now at 44% in the most recent quarter. Additionally, Applovin is entering into the e-commerce advertising industry, expanding from just the mobile game industry advertising, and that has investors very excited, including myself. The e-commerce advertising industry is growing quickly, as I've seen results from companies like Walmart, Amazon, eBay, and others that are developing significant revenue streams from their websites and selling advertising on their online shopping sites. So this is a category that Applovin can find huge success if it can execute well. And already in the first quarter that they reported their pilot, they generated $100 million in revenue from e-commerce. So that's a category that I'm excited about for Applovin. And then the profit margins are soaring up to 40% in the most recent trailing 12-month period. You can see that jump higher from negative in 2023 up to 40% in a little over 2 years. And with this kind of performance, I can understand some investors being skeptical about the company's reporting and questioning how has the company managed this type of increase in operating profit margin in such a short amount of time. And this is rare, right? You've seen me report this metric on, over 100, 125 companies. I don't think I've seen a case of a company having this kind of success in this short amount of time in improving its operating profit margin while also generating significant increases in revenue. So it's been a very successful story for Applovin over the last 2 years. And the increase in stock price has been justified by the company's fundamental performance. So this increase in stock price, it's not like other companies that have increased the stock price without the justification, right? Like the example I'll give is Tesla, where the price of Tesla stock had soared, especially following the November elections, without the justifiable reason for the increase, right? It was just momentum driven. It was just excitement driven. It wasn't based on increases in revenue, increases in profit, increases in cash flow. There weren't any of those factors in there. It was just optimism fueled. This is the opposite with Applovin. The company had increased revenue meaningfully and profit margins meaningfully, and cash flow from operations to sales, a similar trend line to its operating margin. So these are the kinds of fundamental metrics I look at. And when these fundamental metrics are improving as strongly as Applovin is improving them, it justifies a premium valuation. This is the kind of factors you look for when you're paying a premium valuation. You want to see these kinds of improvements in revenue and profit and cash flow when you're paying a premium price for a business. And look at the returns on investor capital showing a similar exponential improvement up to 35.83%. So revenue growth over 40% and expanding as they enter into a bigger category that's growing faster in e-commerce, growing from mobile gaming. The profit margins expanding, cash flow from operations expanding, return on investor capital expanding. All, if I were to give them a grade, A+, 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 on 3 or 4 of some of the most critical factors I look for in an investment. And finally, valuation. So valuation is not cheap here with Applovin, especially after the big increases in 2024. Applovin is trading at a forward price to earnings of 33, which is relatively cheap still when you're looking at the metrics, right? When you compare to those fundamental metrics I just shared with you, at a forward PE of 33, it looks cheap. Because if I were to compare, all of the companies trading at a forward PE of 33, and then we were to look at all of those companies on revenue growth, on cash flow, on return on investor capital, I would be almost certain that Applovin exceeds or is in the leadership, is in the top 1 or 2 of all of the companies that are trading at a forward price to earnings of 33. The price to free cash flow is a little more expensive at 52, but again, excellent metrics, and this would justify the valuation at 52. Given the performance, it looks like where it should be. I would even go so far as to pay a price to free cash flow of 60 to 70 for a business with this kind of performance. All that being said, when I did my discounted cash flow valuation for Applovin, the valuation didn't look as attractive. In fact, it looked overvalued on my discounted cash flow basis. The intrinsic value I calculated was $143, and the current market price is $313. Part of the reason is the discount rate at 15% is relatively high. The growth rates I forecasted for Applovin, I have the company's free cash flow growing from $2.8 billion up to $9.9 billion by 2034, so roughly tripling its free cash flow over the next decade. Maybe I was too conservative with that forecast. Maybe that's why the intrinsic value per share came in so low. That remains to be seen, and I'm interested in your thoughts about that calculation. But in sum, when I look at all of the valuations, it still looks like an attractive investment with all things being considered. So to update my recommendation on Applovin stock, I still think it's a buy, and I updated that today, March 17th, 2025. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.